Hey, what's up, everyone? Welcome to another episode of Trading Takes with me, Sam, Chris, and Judah, presented to you by Investors Underground. Tonight, we'll be talking about accountability, trading systems, and a whole lot else as well. And for all of that, we obviously need a special guest, and I'm particularly excited about tonight's guest. He's probably been one of the most influential people within, my short trading career. He is the king of systems. He is the R guy. It is, of course, Mr. Brian Lee. Brian.
Thanks, Sam.
How you doing? I like a big intro.
I didn't know I was that influential for you, but that's nice to hear.
Oh yeah, absolutely. And I think well I think like you've been that guy I slide into your DMs when I don't know, perhaps when I'm feeling a bit crap, or when and you're just really helpful. And I think there's a few things that you really helped me overcome, just about like styling my system. And I think one of the key points was actually, I always think the system, like when people talk about systems, there's some sort of like really complex set of, I don't know, data or spreadsheets or whatever. But actually, it can be quite simple, right?
Yeah, I mean, systems, everyone has systems. It's just your process. It's like, if this happens, then I'll do that. A lot of times in trading, it's just so emotional all over the place. If you kind of pre-plan scenarios, it's kind of like what Nate says, like when people give him a hard time about his plans, he's like, if it does this, then I'll react this way. If it does that, I'll react this way. Right. So it's like everyone's thinking this way. It's just more of kind of how much emphasis are you placing on that and the importance of like your actual performance. And in my opinion, like, I just learned that I can't really trust myself necessarily to make the right decision at the right time every single time. So that's where systems kind of are a high priority for me.
Yeah, I think for me, I can't really trust myself to make the right decision a lot of the time. So having something quite black and white, as in X happens, do Y, and then I try not to worry about the gray that's in between. But just before we get started, let's go over last week's competition. And a massive congratulations to Sylvia Carl. You have won a free month of IU. Your aha moment is quite boring. Hey, aha moments, the more boring, the better, in my opinion. And every aha moment is worth mentioning. Rules matter. And yeah, I love it. Rules absolutely do matter. So congratulations. And we're running the exact same competition for next week. So Sylvia, if you message Tyler at investorsunderground.com, you will get a free month. And then, same question to this week. And I asked, we had Brian Shannon on last week. I asked him same question. Brian, do you have an aha moment that stands out within your career?
I think one of the biggest ones, I mean, there's obviously, everyone has thousands of them, but probably the biggest breakthrough one was just how actual profitability works in trading. How you can kind of just boil it down to your average win, an average loss ratio, your win rate. It doesn't have to be like a hard rule, like, hey, you have to have 3-to-1 risk reward, or like whatever it is. Like if you have that correct balance, you can basically assume that you will make money over time. And that's where like the casino analogy really, makes a lot of sense. And I feel like people throw that term around, but haven't really explained it extremely well. And once I put it all together, like that kind of changes everything, because it's not a like fighting for a win every single day. Like you must win, you must be green. It's more of like, can I just take the trades that have edge? Can I follow my process and understand like this is going to lead to long-term success? And that's kind of like changes your entire psychology, because now you're just thinking like, how do I perform well versus the need to be right and satisfy your ego.
Yeah, absolutely. And funny you mentioned casino, actually, because just before we came on air, you might not remember this, but Judah was telling us about the first time he ever met you a couple of years ago. Judah?
Yeah, this was when I was playing blackjack. It was like 2:30 in the morning. You tapped me on the shoulder and you're like, I have this extra bracelet. I'm going up to bed. Guardian has a table at Chainsmokers. If you want, you can take it. I ended up taking it, and I was there with them till like 6, 7 a.m.
And I'm surprised you went to bed so early, Brian, because this year or last year even, I'm pretty sure you turned up because we had a round table Sunday morning, I'm pretty sure you turned up, and the first thing you said to me was, "I had like an hour's sleep or 2 hours sleep or whatever it was." So I'm surprised you went to bed that time. Right, let's get stuck into tonight's first topic. We are talking about self-accountability. I know it's a buzzword, and it's often talked about as a really important characteristic for traders, just to recognize, fix mistakes, and perhaps adjust with the cycle. We might talk about cycles a little bit more later, but often one of the biggest issues that I see is people are extremely harsh on themselves. So Brian, the question to you is, how can you be accountable in a really healthy way that's not detrimental to your mental well-being? We're starting deep.
I think if you're harsh on yourself, you're probably not as harsh as I would be on you. I think the harsher the better, to be honest. I understand like negative self-talk's not very good. It's not very positive, but I feel like you can kind of channel negative energy in a positive way as long as you don't sustain that throughout your career. I mean, I think you're going to make a lot of mistakes. You're going to make a lot of errors, and I think they justifiably should be punished, and you should feel bad about it. In terms of like what I bring into trading, like from my competitive gaming background, is that like when I was a leader, I was extremely hard on everybody, and that kind of brings the best out of everyone. The thing is, like, you just can't be a hypocrite. Like, if you're going to be hard on other people, you need to be as hard on yourself, if not more, and take accountability for that. So I think like people who really succeed take accountability in terms of like how much influence that they have over situations, even if it's not necessarily in their control. I think like if you're hard on yourself, it's very easy to recall like all the lessons that you need to learn. And overall, like you should be holding yourself to a very high standard, in my opinion. It's a very competitive game. However, I will say, you know, like you do have to understand when these kind of voices that you listen to, especially if it's your own voice, are not very helpful for you anymore, because it changes throughout your career. Like if you're a beginner, being hard on yourself and really taking those lessons to heart, like not slacking off your discipline, is very important. But as you develop as a trader, you need to be more confident in the skills that you've grown over time, be more kind and compassionate with yourself, really understand like how to take something on the chin. You know, like when things are not your fault, let's say for example you get slipped, something breaking news happens, or you go into a halt or whatever, like that is completely out of your control. Like there's no reason to blame yourself for that outside factor. Or if you just have a bad beat, you hit like a tough market or whatever it is, that's just all part of the game, and you have to be able to coach yourself through that. And so I think like you can evolve from a place of like, hey, I'm a complete beginner, I need to understand what's right and what's wrong, and really build that into your trading system. And then secondly, like learn how to sustainably go through this career, be compassionate to yourself. And for that, like, you know, you guys are no stranger to Kim, but like I worked with her for a long time, and she helped me kind of develop like that inner voice. And in fact, like one of the things she talks about is like the inner gremlin, which is kind of like the voice that's kind of like pervasive through your life, and you kind of assume that it's you. You know, if you have like a negative thing to say about yourself or a judgment, like a lot of times that's actually just like a passive kind of voice that's routinely, you know, putting you down. And unless you become conscious of that voice, you'll never really unlock like exactly what you value, what your actual intent is, and like how you actually perceive yourself. So being passive in this regard is actually a detriment. So, you know, I would say that's something that all traders need to work on and develop at some point, but probably not the most important part, because overall, like the psychology comes after you're able to actually execute and have the edge and all that. So, you know, being hard on yourself can help you kind of use shame or embarrassment to your advantage to show you like, hey, this is a signal something's not right. I need to correct something immediately. And as long as you honestly like reflect on the mistakes you make and just make an idea of an action plan for next time, what you will do, then you can go to sleep comfortably knowing that like if that situation arises, you're going to be prepared in the next time.
Yeah, absolutely. And there's definitely a shift, I think, and this happens, I think, happened fairly early for me, where I was, to be honest, I was just angry a lot at myself, and I used to think, oh, I just need to improve my mental game, but actually it was, no, I needed to refine my edge. And then there's a point now where, you know, I may miss a setup, and I feel like, yeah, I'm going to be angry at myself, because now I just can't justify it. It's not about psychology or bullshit. It's there's the edge, take it. Chris, are you nice to yourself, or do you get pissed off every now and again?
I've changed over the years, and now I try to focus on, like Brian was saying, the key element of accountability is really change. If you make a mistake, or if other things happen, if it's within your control, it needs to result in a change. And I think if people are too easy on themselves, kind of just saying, oh, it happens, no big deal, then the changes that they need to make, they get delayed. But on the same hand, I also think that framing how you make that change is important too. And so Brian also brought up Kim, and she gave an incredible talk at Traders for a Cause this year. And she had a line that really stuck out to me. And it was, when people make mistakes or when something goes wrong, it's asking, what was that all about? Instead of saying, you're horrible, or like, how could you do this again? Or that kind of cycle of frustration. And that's something that I've really taken into my trading. And so when I do make a mistake, or when I go outside my system, or when something goes wrong, asking more, what was that about? Examining it, and then, making those changes necessary. And I found for myself that that's been a much more healthy and productive way of not only creating change, but then also feeling better day to day. Because whether you're new or whether you've been trading for a long time, mistakes are bound to happen. And especially when market conditions are changing, you can be in a constant state of frustration for months at a time if you're making little mistakes here or there. So for me personally, I think that self-accountability is very important, and it has to result in change, but framing that in a healthy way for a long, sustainable trading career is important to me.
Yeah, I think that's a great point about framing it positively. And so Chris, then, like, how do you go about that then? So say you made a mistake, or I don't know, perhaps your edge is changing, whatever it is. How do you then, make that positive change?
For me, I think just examining it for a long time. So, if you make a mistake or do other things, instead of like immediately, like right at the desk, like trying to just automatically correct it, what I like to do is, if it's a new mistake or something I've, done before, I just like to sit with it. Maybe at the end of the trading day, or maybe I'll go take a walk or something, but really just think about it and think what else is connected to that. And so I'll give you an example. I used to have trouble with cutting losses on something. If I had a high conviction trade and I had a difficult time cutting losses. And what I really found out is that after I had like a down period for a while, I was so frustrated with taking losses that it wasn't so much about like the trade anymore. It was more about like, how could I possibly be taking another loss right now? And I would start thinking about that instead of the actual trade. And so just being able to sit with something and be like, okay, I realize that I'm struggling with this issue because there's a lot of other emotions around it, and there's a lot of other things kind of happening to it. So just to be able to sit with it and kind of untangle it, and then write down a plan for actual change. And I found that to be really effective.
No, that's a great suggestion. And I'll go back to you, Brian, for this, but I always think as well that over-analysis can lead to paralysis. So how do you balance that between something being like a little mistake, or just something being, actually, I traded this perfectly, it didn't work out? And then when you're trading well, but it's not working, how are you going to handle that drawdown in terms of, actually, I don't want to over adjust because that shift is about to come?
Okay, that's two questions. So remind me if I don't answer the second one.
Yeah.
So in the first way, it's basically like I use systems to determine whether or not I did the right or wrong thing. So in that sense, like a lot of my signals, entry, exit, everything, risk management is all very like black and white, because I believe there's like kind of an objective way to take certain trades, at least in this niche. And for that reason, like if I make a mistake, it's really something that it could either be myself not adhering to the strategy, or it could be like a flaw in the actual system itself. So if there's like a blatant error in the system, then I'll adjust the system based on the idea of like, how could I have done this better today? And then I'm going to go reflect upon and backtest on like several different occurrences in the past that were very similar. So that's not like necessarily using data, but it's basically like, you should know what looks like this trade or what variables are very similar to this trade. See if your actual adjustment makes sense on the overall kind of like sample size. And if it does, then you can make a long lasting and positive change. However, like what I find is a lot of times you have a knee-jerk reaction and you're like, I should have done this. But when you look at the whole, like, you know, if you look at like 5 or 6, 7 different trades, you'll be like, no, this was like, that's what I need to do. It just didn't work out this time. I think that's really, really important. But basically, like, as long as you create like a condition for next time, like how you're going to approach this trade and you kind of research it thoroughly, then you should have a good plan. And I kind of just like, I mostly fall into the right way of doing things. Like I kind of believe in just kind of like letting experience lead the way. So for me, I'm not really stressing about the next trade. More so like, what is the adjustment I'm going to make? Can I follow through with that? And when I do follow through with that, like, what is the experience of that? So did it actually work? Did it not work? And what were things that I didn't understand about it when I was like formulating the idea? So sometimes like you might have a certain idea, but it's just extremely difficult to execute, or it may be impossible, or maybe even like not feasible because of some kind of issue in terms of like a live market dynamic that you're not anticipating. So because of that experience, you're going to be able to develop a way to say like, no, that doesn't work, or like this does work, and actually apply that for the future. In terms of like that process, like I usually have a notepad, like literally the notepad doc on the Windows, and I just write down certain ideas that I have or thoughts. I'll be like, oh, this didn't work, maybe I should adjust or like tune. And then I don't make any changes or think about it during the market. I just come back after hours. Usually I try to take a break. So kind of like Chris was saying, like take a walk or something like that. I like to work out, and then I come back with a pretty fresh, clear head and like energized. And I'm able to like kind of just really reflect on that objectively, because you see like the whole day's action. You know, a lot of times in the moment, you're just reacting to how you feel at that moment. Like you could be feeling completely incorrectly about that situation, but with a lot of conviction. The hardest part is like, well, the worst part about that is if you act on that immediately. So you don't want to act at that moment. And again, like a lot of times you're extremely wrong. So don't assume like every little thing you figure out in the market is going to be like something that changes your trading forever, because a lot of times it's not. But occasionally you do find something that will change your trading forever. And that's a huge positive change, because that compounds very over the long run. In terms of dealing with drawdowns, basically like every single trader should assume their kind of win rate. Like even over a long period of time, even if you don't track data or anything like that, just upload it to TraderView. Just get a basic idea of like what your stats are, and you should be able to plug that into like, let's say, an equity curve sim, and you should be able to see like, what is my average drawdown? What is my max drawdown? And as long as you're kind of within those parameters, and those always are based on like your win rate, for example, then you know you're kind of okay. However, like if it starts getting outside of that, and you know like it's not a performance issue, and let's be honest, like a lot of times it is a performance issue. A lot of times like you are making mistakes. So until you get to the point where it's not a human error that you're making, you know, then you can actually look towards like the actual model you're executing. But again, like a lot of times it is a performance thing. So I've had friends who basically like shut their system off until like they can like basically paper trade out like the result of their next trades, and see that their trading starts trending over like a moving average on their equity curve. Then they initiate the system back. A lot of like market wizards have talked about that as well in like some of the books, if you kind of recall those. Those systems are pretty good, but personally I just kind of like deal with that situation by reflecting like on my system. And then I also reflect on like, you know, is it a factor of like, well, I'm always very cognizant of like market cycles, for example. So I'm trying to pay attention to, is this market regime not conducive to my trading style? And then secondarily, like, because I'm adjusting my risk day by day through the process of compounding, if I'm taking subsequent losses or like big losses days, usually I'm reducing my risk with the scale of my account size. So it kind of naturally takes care of itself in that instance. But this is all assuming like you have really good confidence in your edge. If you're a beginner trader and you don't have a lot of confidence in what you're doing, then you should take that as a signal to kind of step back. But I think with experience, you'll be able to know what is my market and how am I affected by that, and how's my system affected by that. And one thing I want to add really quickly at the end of this is like, you don't want to over adjust or overcompensate for one market. And this is an extremely important actually in one of the scenarios that are not very intuitive, which is like when you're doing well. So a lot of times when people are doing really well, they assume that they can boost the performance of their trades by like adding to winners really heavily, aggressively, pyramiding, going with bigger size. And actually those are like the biggest flaws that you can make, because when you go into a market that becomes more like neutral for your strategy, or even like against your strategy, right? You have an adverse reaction, then you will lose all the confidence because the optimizations you make are just going to get completely blown up. So what I find is like I try to label each different like type of cycle in the market, like is it bullish, is it bearish, is it neutral, and then try to formulate like my strategy to be able to weather all of those cycles at a pretty average level, instead of like overcompensating, like I'm going to nail only the bull market or I'm only going to nail the bear market. Like you can't really think that way, because you're going to have these cycles in time where you're just completely like shattered and lose all your confidence, or that your strategy just doesn't work. So that's my approach personally, so that I can be here year round, because you never know when the opportunities will present themselves.
And you must have read my mind, because that was going to be my next question. And I'm sure we're going to talk a lot more about cycles, because I really want to pick your brain, and I know it's something you've been extremely vocal about. But just before we do that, Judah, are you nice to yourself?
Usually I'm not too hard on myself. If anything goes wrong, I just try to like move on and not dwell on it. But if I were ever to be hard on myself, it's because I didn't follow a rule. So that's where it all comes down to, is following the rules, because there's no reason to be hard on yourself if you followed a rule and you stopped out for what you expected it to be. Like that's what happens. That's you can't be here in this game if you can be hard on yourself for natural causes and rules and things that you're anticipating. So if it's things that I'm not anticipating and I lose more than what I set out to risk, that's also not on me, because I had my rules in place, and over time, you're not going to keep losing that same way. It's like, one in a few that it happens that way. So it's really just about trying to keep the rules straight and follow them, and then being hard on yourself. It doesn't really come up as often as it would if like you were breaking rules and doing things that you shouldn't be doing.
Yeah, thank you. And Brian, you just touched on then sort of having bullish, bearish in a neutral cycle. Are you ever more nuanced than that? And just as an example, like I started, I suppose as part of my backtesting, part of my review system, I started tagging at black swans or just like outlier events, just because I want to adjust in the coming days after that. Is that something that you do as well?
Yeah, I mean, it's definitely, to me, I view it kind of different stages. It just so happens in small caps in particular, like it's very cyclical, very predictable, especially if you've been here long enough. I mean, like maybe if you were here for the last 2 years, it might be kind of different. But if you were here for like 4 or 5 years, I think you kind of really get the ebbs and flows of the market. But like one thing I was pointing out to people that I talked to is that like in this current market, actually, we're experiencing something very similar to COVID. And this is a total regime change in the way that the market's actually reacting. So it goes kind of beyond bull and bear. And what happens is like, again, like if you only traded for the last 2 years, you wouldn't understand like what COVID market is like. And so that can completely throw off your experience. So it is really helpful to be able to talk to people who have gone through that experience so that they can point it out. But I think that in terms of how to identify cycles, it really is all in all about, like, fundamentally, it's about just understanding the mass psychology. It's like, where does the confidence lie, whether it's buyers, sellers, or if there's no confidence whatsoever. So for example, like when the interest rates are going up, right? Or there's a war in Ukraine, the market kind of like did not really move too much, like in all sectors, like small caps, large caps, whatever. However, like once the confidence comes back, even something like your friends asking you about investments, Bitcoin's going up, market's an all-time high, a lot of confidence in different sectors like AI, whatever, right? Like all of those things drive different players into the market, and it's all about the exchange of money regardless. So dependent upon like who wants to show up, who wants to play, who wants to invest, who wants to make some gambles, right? Like that's going to change the way the market interacts. Because at the end of the day, a lot of these like imbalances that occur that we take advantage of as traders occur because of human emotion. So you just have to kind of read the room and assume like the position of other perspectives. So one of the things that was really helpful, for example, was like, if, for example, you're a long trader in small caps, it would be really helpful for you to actually learn how to short sell, even if you didn't intend on doing that long term, because you'll understand like the pain points, where the stops are at, how people react to certain times of day, etc. And I think like if you really kind of hone in on your niche, whatever it is, like I can only speak for small caps because that's what I trade, but I assume it's similar across the board. Is like once you really understand the dynamics of your market and the players and the positioning, then that's where like kind of you can get a read on how effective your strategy might be at that certain time.
That's a great point. I actually had a text message earlier from a friend, and I haven't spoken to him I maybe spoken to him once in the past year, and he just sent me a picture of the Nvidia chart with sheesh underneath. So it seems like we may be approaching that level. Right. I think I want to move on to trading. We've got the king of trading systems, and one of the things that like blew me away, I think, when first started, well, when I joined, I think I started as a super follower back. I don't know if that's still going. So yeah, joined Brian's Discord room, and I think one of the things that sort of like I said blew me away was actually systems don't need to be complicated. So Brian, I want to ask you a really basic question. What are the most important elements of a trading system?
Important elements of a trading system. I think it has to be well considered and also well tested. So for example, like one very common mistake people make is, let's say that you're using a higher time frame moving average or system or signal. You have to recognize the fact that systems repaint. So that's one thing that people will understand when they use like indicators, for example. So you might have a completely perfect signal for the next 4 minutes and 59 seconds. But at the 5th minute, if you're using a 5-minute confirmation, it can go the other way very quickly if the price happens to shock or absorb or do whatever it does, like that does not confirm the signal. So you have to really understand the dynamics of time and what signals you're using. The other thing is you want to, again, like consider all the factors I talked about before, where if you make one change for a very hyper specific situation, you're not doing it right. Like you have to really consider that you're looking at the large samples and you're trying to figure out what on average performs across the board. Like that's kind of the idea of it. I mean, this is really for technical like signals. Systems is a very broad term. I mean, you'd have to like ask something more specific to get a more specific answer. But in terms of like overall systems design, I think overall, I would say like do not have paralysis by analysis. A lot of times it's just you have to do it. Like you just have to try. It's about collecting the experience and figuring out, is this something that I can move forward with? But the beauty, in my opinion, of systems overall is like there's something to be said about compounding in general, like compounding skills, compounding accounts. Systems are an act of compounding, because when you decide upon a way you're going to react to a certain situation in the future, and you make that rule-based and process-based, that can be something that carries with you for the rest of your career. You could have discovered something in year 1 that you're doing year 20, or you could discover something in year 5 that you never considered before, and it can completely dramatically change your trading forever. And the beauty of that is that you no longer have to consider that aspect of your trading if you, for some reason, develop a good enough system. So that's why I think it's really important to just think this way, because naturally, every single day, you have a tangible way of understanding if you did actually make an improvement.
That's a great answer, and I deliberately left that open-ended. And Chris, over to you then. Like, to be honest, I don't know that much about your trading style. So how would you, and obviously I know what you focus on, but how would you describe it? Would you describe yourself as, do you have a system, Chris?
Yeah, definitely. So I came from a speculating background in natural resources, and then a business background and value investing. And then later on in the game, I got more into shorter term trading. I used to do a lot of special situations, parabolics or gamma squeezer, odd things where I could understand the structure. And so the way that I've always approached either trading or speculating or investing, I frame it with risk, reward, and probability. Those three pillars are basically what shape expected value. And so whenever I'm going into, because I go across different markets and activities. So whenever I'm doing something, I frame it with risk, reward, probability, and then basically how does that play out as an expected value? And so whether it's something, with more of like a venture capital side, or whether it's something with options trading, if I clearly know how much I'm risking, if I know what the potential reward is, and I know roughly how likely it is, and I can put together basically what this looks like if I were to do it, 50 times or 100 times or 1,000 times, that's how I basically approach a trading system. So those three things are kind of like the broad view. And then if I go into something that is much more niche, then I basically just look for the people who have edge, people who have done it successfully, and then I build my risk, reward, and probability framework. I model it after kind of the best that I can find, and then I tailor it to my own. And so that could be, I'm not a short seller in small caps, but like Brian was just saying, it's really helpful to understand that process. And so, you look at someone like Nate or someone who's done it consistently for a very long time. What are the key variables for them? They're looking at key levels. They're looking for a failed follow through. They're looking for people to be on the wrong side. And you basically just understand their process, and you understand why they're able to lower their risk, why they're able to go after things with magnitude or high reward, and then they're highly probable too. So that's how I approach a system, and I operate across several different markets.
Thank you, Chris. And Judy, you're often known as the news guy. I know there's a lot more to it than that, but would you say that do you have a system?
It's really like the same thing that Brian and Chris said in terms of like, first you got to figure out what systems for you, because there's hundreds of different ways of trading. And like for me, it was just taking a bunch of ideas from a bunch of different people, putting them together, testing them, and seeing what worked for me. And then the most important element of the trading system is actually following it, because everyone has their own trading system, yet something will come up and they'll take it when that has nothing to do with the system that they built. So just figuring out like what kind of trader you are, and then following those rules. And that for me, that was just copying other people at first and putting it together. And that's all I feel like it is.
Mm-hmm. Yeah. And you touched on a good point there. And I think I want to ask Brian this, like, how did you, when you span the dial, how did you end up on, specializing in small caps?
Just, I mean, look at all the people in IU and things like that. Like, it's just very prevalent. It's something that I was introduced to as a way to trade with smaller count. And honestly, I can't disagree. Like, I think yes, there's a PDT and stuff like that, but small caps is a great way to improve or to like build your trading account actually. And there's plenty of examples, but probably like the biggest one is maybe like Christian Koulamagi. He started in here, he built scale, and then he moved on, right? It's just the reason why I believe it's like very nice to start in small caps, and the reason why I kind of stuck with it is because the edge is like pretty simple. It's very clear. You can test it, you can analyze it, and also the second factor is like that there's a lot less competition in terms of the larger players. So for that reason, like I think I just stuck with it. And I had a conversation, or I didn't have a conversation, but my friend had a conversation with our broker, and they were talking about how like there are these traders who made an insane amount of money in small caps and still trade small caps. And the thing is, like, all they did was just take their expertise and just perfect it. And these are traders that are like a 9-figure level. And it's just like, it's mind blowing because like you don't necessarily think that's possible, but when you recognize like how deep you can go in terms of your expertise, then I think that really helps with like the imposter syndrome people feel, because a lot of times I think people use small caps kind of like a stepping stone, or they view it as something like, you know, it's just here for small liquidity, that's it. But there's a world beyond that. And so for me personally, like I've always been driven to just perfect it and be the best I can. And when I'm the best at short selling, I'll be the best at long buying as well. So there's so many dynamics to the field. And that's why I think it's really interesting. It's all about the volatility.
Yeah, and I think, like, for me, like, because I think that there is, like, it is perhaps there's this perception that small caps is a stepping stone. You start small, go to large caps, whatever. But I think, like, that's another area where you've helped me. It's like, and then I know, and now I know, I don't know them personally, but I know of some of those 8-figure, 9-figure guys, and they're like, yeah, we're still doing the same stuff we did, you know, a few zeros ago. Chris, you've just touched on then risk reward and win rate. Now, I think there's a real fine balance with this, and this is where, like, I think being aware of your system, creating a system, you need to know both of those factors. And then you mentioned expected value as well. But how do you find the right balance with those factors? Because obviously there's the flip side of people having a 90% win rate, which sounds great, but then when they lose big, eradicate all those losses. And then obviously got the flip side, if you had a really low win rate, you have to be able to sort of handle a drawdown for perhaps like a lengthy period of time. And Brian mentioned Koulamagi, and I think your win rate actually might be a similar level. I believe it's around like 30-40%. So you need to be able to handle perhaps taking a few losses in a row. So how do you maintain that good headspace within your career, Chris?
Yeah, I think part of it depends on which market you're operating in, because some markets inherently have lower win rates. And so, again, I'm not really active in the venture capital market, but that's an example. Like, think Shark Tank style, where you have someone who's going around trying to finance companies, and they might be financing a portfolio of 30 or 40 companies. And out of that, 1 or 2 might be the unicorns, and they might go public, and they kind of amortize the losses of all the rest. And so that's an example where, a 5% win rate can still be a positive expected value if someone is an expert in that field and they're able to catch those 1 or 2. And then on the other end of that spectrum, you might have someone who is, selling options or, doing things like that, where 90% of the time they are, making money, but they have like a huge tail risk to it. So, it could be the opposite, where they might be right 95% of the time, but that 5% could take them out. So what I look for is, depending on the market that I'm operating in, you just want to make sure that you're optimizing each one. So what that basically means is that you want to find a game or find a strategy where you can have a lot of reward and you can have a very low amount of risk, or at least an appropriate amount of risk. And then once you have that, you basically just try to optimize your win rate to the highest of your ability. And so, like, for me, whether that's trading options or doing long equity or a play like that, it's really about, okay, if I have this system, what are the things that I can do to constantly be lowering risk? What are the things I can constantly be doing to raise my reward? And then what can I possibly, constantly be doing to raise my win rate? And so it's more about, as long as you have a positive expected value with those 3 factors, that's like the first step, to make sure that you're in a good positive expected value game. But then most of the rest of the time is about optimizing that and constantly just chipping away at lowering risk, raising reward, and raising probability.
Great response. And Brian, do you have anything to add to that?
Yeah, I think Chris is totally right about that. Like, for the longest time, I think it's been very common for traders to focus on certain strategies like very low expected value in general. And I feel like no matter how good you get at that, like, there's still a limitation there. Knowing that there's a big amount of reward possible, and then managing the risk around that, like, I think that is actually really, really powerful. I think generally speaking, optimizing for win rate is definitely the right way to go, because there's so many things you can do about it. It's like, if you have a low win rate, you kind of have to deal with like pretty bad drawdowns. Whereas, like, if you optimize for win rate, you can actually like increase your position size, not even just not even just like adding to a win or something like that. I'm talking like literally just increasing how much risk you put on initially. Because if you actually look at the math of that, there's a point where like you will have a drop off in terms of how much you actually make per risk you put on that trade. And this is where like knowing your strategy really well is important, like knowing the kind of the basic expected value that you can kind of assume. But like you can put more risk on trades with higher win rates because they naturally tend to have smaller drawdowns. Whereas like if you put more risk on a lower win rate, all that does is increase your actual drawdown potential. And every once in a while you'll have a good win, but it's not really that great. So I think, you know, there is definitely a balance there. I've done optimizations where I've gone like extreme end of reward and it works great until you take some losses. And then I've gone the other way of like too little reward, like high win rate, but you just don't fully capture the opportunity. So I think like the balance for me is kind of just finding that drawdown that I can accept, because ultimately that's going to have a really big impact on you throughout your entire career. So for example, like if you, this is a really good example about something that I've been learning recently about something called arithmetic versus geometric returns. So arithmetic is just like, you know, you risk 1%, you risk 1%, it's always the same. Geometric assumes compounding. So what traders forget is like, even if you build your account up, like, you know, let's say you build your account 10%. If you lose 10% the next day, then you're actually down, you know, like it's, I think you come back like 9% or something like that. And it only gets worse the more money you build up and more you compound. So you have to be aware of risk of ruin, number one, in my opinion. So depending upon your strategy, dependent upon the kind of win rate that you can get with the way that you enter and exit the trade and the risk reward, you can optimize for risk of ruin. In my opinion, that's the most important part of it, because you never want to overplay your hand. You never want to like, you know, try to overcompensate for whatever it is, like you're feeling that you're not satisfactory or that you're not winning enough. You always have to think about the fact that like, if you took that trade, you know, hundreds of times, the way that Chris was saying, that you're going to have that positive expectancy and the fat tail risk is not there. Like, I think that's a really big deal. And a lot of times it's really as simple as just putting into equity curve sim after you've got enough data for yourself. And usually the data that I pull is not like I put into a program and it spits out like this is the average risk reward and the average win rate. It always, to me, comes from experience. So I'm gathering data on my own personal performance, and that informs my ability to position size. That informs my expectations for risk of ruin. And in my opinion, like having risk of ruin at one, like nearly impossible is the ideal way to go. So one of the ways that I do that is by wiring out of the account so that I don't follow that geometric pattern where like you build more risk and the falls are just, you know, you just lose more money. That's the difference. But like that, you know, it's something to lose 30% when you're at 30K account, and it's another thing when your account's $1 million. Like the impact is going to be much greater. So don't feel like, you never want to assume that like within your strategy and the way that you're trading, that just because you hit some like P&L marker that it's going to get easier. The risk is still there. You must always consider the risk of ruin and understand the expectation of your strategy so that you can position size in a way that is not like, there's something called like a volatility drag, which is like the more risk you put on, the more drawdowns, right? If you happen to have a bad beat, and that volatility can actually affect your returns versus if you just kind of like traded very, very standard, a very uniform way. So you have to think about like the effects of compounding and compounded risk and make sure that you manage that correctly. So that's why a lot of traders can get lucky for some period of time and end up blowing all their account up in one go, because they don't understand, like, you know, what is that famous example? There's a person who lost like, you know, made like 8 figures, lost more than 8 figures on one short sell or 2 short sell. I don't even know, it is maybe 1. And that's your whole career. Boom. Like, you would assume at that point in your career that you're done, you're smooth sailing, but all of a sudden, like, you have no career, right? So it can happen at any point. We have examples like Jesse Livermore, etc. Happens all the time. So never assume like it's always going to like reach some point where you don't have to think about this. You always have to think about it.
Yeah, that's interesting. I don't know about that story, but we do often see on social media sort of people risking, I don't know, 10+% of their account. And I think obviously as it works, that's great that your wins are huge. But I think there's also, I don't know, Brian, would it be fair to say that I don't think they fully understand that there is an element of luck in there, just because there is such a high % chance of risk of ruin, but they're somehow surviving, and perhaps they don't quite have that switch to flick to perhaps something a bit more modest in terms of risk management.
Well, like this is something that I've been studying recently, which is like the Kelly criterion, and it's kind of like no one in their right mind is going to trade a full Kelly, even though the expression of the Kelly criterion is that it's the optimal bet position sizing. Given all the factors we talked about, the average win rate, average risk reward, etc. If you go full Kelly, like I've done simulations where you can grow like a 100K account to 20 million, and you'll draw down 90% at some point. Like it's the same thing like going to casino. You're gonna, maybe you get lucky, but you have to be able to stop. But the thing is, like, people always assume it's always gonna work, and so when people like place these big bets and they consistently work, they become addicted to that feeling without any consideration for the fact that like you can get lucky for quite a long period of time and not understand the exposure that you have to like a massive devastating loss. So that's why most people who even understand the Kelly criterion go half Kelly, which in my opinion is like actually still insanely aggressive, and most of the times even go less. So in that respect, like I question whether or not like, hey, if you believe in that, then go full Kelly. Then like show me a result full Kelly, because I guarantee you probably blow up. And the reason why is because in trading, like no matter how great the probabilities are, it's always changing. Like you can't assume that you're perfectly going to hit the metrics that you have always hit or that you simmed out. Like you're not always going to have the same risk reward. You're not always going to have the same win rate. The expectation is always changing. So you have to account for the volatility of those numbers. You want to try to aim for a certain kind of average level, but like if you try to say like I'm going to go always optimal position size, and that for whatever reason, like even in my own trading, like it says like if I were going optimal position size, I would be going 9% of my account per trade. I've had a friend's statistics telling him that he'd go like 26% of his account on trades, just because his win rate is like there. But again, like if you really understand the way that equity curves go and the tail risks, like you put those into a long enough kind of chain of trades, you're going to see that risk is unsustainable. So the first thing in my mind that makes the most sense is to focus on being sustainable, understanding like trading in the long run has a much bigger expected value than like having a big win right now, because you're always compounding your skills in your accounts. And so that's the number one thing you want to focus on. Now, like if you happen to, let's say, have a strategy that can support a larger position size, I would just make sure that your risk of ruin's in check, in the sense of like you have to understand like what is the potential drawdown. For example, like blowing your 100% of account is not the goal of blowing up. Like you can't say like, oh, I lost 100% of my account, okay, that's when I blow up. It's more of like the more you lose, the harder it is to reclaim, right? You lose 50% of your account, you need to make 100% back. So in fact, like you can blow up much sooner, in my mind, than what people assume. So if for example, your strategy says like, hey, let's go, 5-10%, but then at some point within that model, like your max drawdown on, let's say, a black swan event, which happens all the time, by the way, outliers always happen, is 50% plus or whatever, because you're risking 10% takes 5 times the loss, right? This is all assuming that you don't make human error, you don't make any egotistical emotional mistakes, that you don't have, let's say, a freak accident of like your platform breaks or the market breaks temporarily or the algo's all shut off, whatever, flash crash, right? This is all assuming none of that happens. and you still can have that potential risk. Like at that point, it's never worth it, in my opinion, to take that trade. So understanding that the math kind of can inform your trading decisions quite a bit, especially with position sizing. That is, like, to me, the most important. However, like, what I find is 99.9% of people don't even really understand that. I'm not like a master mathematician. I literally just have like a really good sense of like equity curve sims. I track my stats, my performance. I have like 5+ years of actual performance of every single day of what's the risk reward, what's the win rate, all the executions. And you can plug that in and just see month to month, like, hey, in January, I had like this X% win rate on my strategy. This was the average risk reward. And what you'll find is like there's a lot of volatility. So you can find like on 1 month, you make 2 to 1. 1 month, you make 3 to 1. 1 month, you have 50% win rate. 1 month, you have a 40% win rate. So the aspect of like trying to say like, oh, I have this perfect idea of exactly what the expectation of my trade is just very naive, in my opinion.
That's a great answer. And I love how I could say just a few things to you and it just resonates and you just, yeah. And I said to myself I wasn't going to mention SMCI today just because we've mentioned it. I don't know. I think this is our 7th episode. And I think Judah, Chris, and I probably we're a bit bloody exhausted about talking about it. But there's a lot of people talking about SMCI as, particularly Friday's move, as sort of opportunity of, insert however many years. And I think my understanding is right that you go against that school of thought in that you would have had normal risk and it would have been just I think you had the day off, but it would have just been a normal opportunity and you would have treated it as such.
The way I capitalize on moves is through like building risk conscious positions. So it's like I'm not going to just on my stop level just increase the risk at that point just because I feel like it. A lot of times I'm building the position as the trade goes. So for example, like with SMCI here that you have up, there was a basically bloodbath going on there, which is completely selling off. That's a great opportunity for someone who's like very risk conscious to like keep lowering their stop and adding more position. Like your risk still remains the same, but your output grows quite substantially. Like for example, I've had a couple, like I literally had one of the best trades of my career this month where I had like a 26R return. And that is not like that's not because I put on like a 20R risk. I still had a 1R risk. It just so happened that like I was able to build a position with a risk conscious stop level and have a massive return on that. Like I think that people are far too focused on like the singular like anomaly opportunities, whereas like the way I view Edge is like you're naturally going to compound your account and your skills. The next like have you ever had this phenomenon? Maybe you can relate, maybe not, but like as a trader, I feel like when you start out, it's kind of like you make a trade, it's your best trade ever, right? Or you have a great month. But then a year or two later, that great month, you made it in like a day, or you made that half year in a day or like a month, right? You made your whole year in a week, things like this. There's an exponential effect to being consistent in the market and like really focusing on growing the opportunity. For example, like on this a month alone, because the market was so conducive for my strategy, like I made 100R in this month right at this point, and that's a 300% compounded growth. So like when you talk about really needing to nail this one opportunity versus like having this consistency of just being able to compound your account, I feel like one way has a serious drawback in the sense of like people are naturally wired to think of the outcome of a win. Like they love a feeling of a win, even if it's in their mind. Just the thought of like, how much am I going to make on this trade? And what that does is that influences your decision making. So for example, like what Chris was saying, how if you get so big and so convicted in a trade, like sometimes you can't accept a loss, even though you maybe have so much time to prepare for it. Like it's not even just those times where it just shoots against you and you're like, oh, I have no time to react. Sometimes it's a slow burn where you're like, I can't, like I was up huge, it's suddenly going against me. Like you just can't trade properly. And I feel like the reason why I focus on performance and being consistent is because I value the execution of like high level performance more, because in the long run, that's going to actually, compound to far greater extent. Because like, for example, when I blew up my account, like way back then in 2018, 2017, I lose 100K or so. It's like, you think at that point, like that's a lot of money, but then as you become a bigger trader, like 100K might become a lot more inconsequential for you as you grow and develop as a trader. So you don't know if like this mega trade that you're nailing right now is going to be the peak of your career. Like it could actually be the end of your career in a lot of cases, like for a lot of people, or they could position size so big that they cannot like trade well, so they just end up scalping it, and maybe potentially would have had a bigger return if they had executed well. And so I just think like, trading is just not, in my view, trading is something where it's non-linear. How many traders were able to retire like off of COVID or whatever like that, or made so much money? Like sometimes it's just that 1 year or two where everything just lines up for you and you can become financially, independent, financially free, however you want to call it. You can let your money work for you at that point. It's like, I never felt like I want to win the lottery. I'm here to execute at a high level and do this consistently. And for me, that's way more satisfying. So like missing one trade is not a big deal. Like, I don't know how big my risk will be next year or the next 2 years. It might just be like that biggest trade ever was just a normal trade for me in the future. So I don't feel like this feeling. And I don't know if you've read the David Hale was passing his book around in Trades for Cause. Well, I actually ended up finishing it, and it was pretty crazy because he talks about how like in his like prop firm experience, like a lot of the traders feel like they need to go really hard at like the exact right moment, and if they don't, there's like a massive amount of remorse and grief associated with that. And in fact, like he mentioned how he actually missed a couple of those opportunities where he just didn't hit it hard enough. His strategy really relies on those glitches, he called it, market glitches, and really there's imbalances, things like that. And because of this, like there's this huge insecurity and huge need to like always be right at the exact moment and be the biggest you can be, so that you can survive for all the times that nothing's going on for you. And what happened in that situation was that he ended up becoming divorced and homeless, like because none of those opportunities came for him, and he missed the ones that he didn't capitalize on. I feel like it's a very sad life to always live by the next A+ trade versus like knowing that you can consistently show up, treat this like casino, play the expectation, risk something that's not really going to hurt you. You can bounce back easily, compound it, wire it out. Eventually like everything that you're making now will be so insignificant in the future, you won't even believe it. And the amount of like trades where I felt like were impossible, like I never thought, for example, like a 300R month was possible, and that was possible for me. And you can just imagine like 100 Rs is 300% compounded growth. So what's a 300R month, right? Like I can't even tell you. But you do this consistently, like you're not going to sweat it. You're not going to care that you missed some trade. You can go enjoy your life. You can take time off and not feel like you miss like it's what we get into the market for, so we can have free will. And like I think it's kind of sad to like be remorseful or something. The other thing I will say is, when people talk about like mega A+ setups, a lot of times it's a liquidity need, like for somebody who has a very large account, right? Like this is an event that they can actually exercise a full potential, like, and move a needle in a meaningful way. Let's say you're some like trader with 30K account and you're like, I need to go all in right now. What if you lose? What if you win, right? You're going to make a small amount of money. Like the opportunity that was presented for you was not fully capitalized on regardless. You didn't need that risk. Whereas like for smaller accounts, the greatest thing is that you actually have like full liberty to actually take a lot of different setups that larger accounts can't take. So somebody's like nobody can define like A plus for you because it really depends on your circumstance. Like if you need that liquidity, hell yeah, it's a perfect opportunity. If you have the ability to take full advantage of it, hell yeah. If you're a small account, like what is the pressure? You're gonna make like $10,000 and your 30K account, you're gonna be like, oh, that's really awesome. But like you'll make $10,000 in a single trade, and like, you know, it didn't really change anything. It just all it did was bring like a massive amount of stress for you, you know. And it's not really teaching you like about risk of ruin. And I'm pretty sure what it does is like forces you into like skipping levels where you kind of like all of a sudden like now you have more money to play with, you increase your risk. You cannot handle that risk because all of a sudden like you just had this massive cash infusion and you never got to experience the different levels of risk in between, an interplay of like accepting risk, learning how to like not only accept the risk in terms of trading, like how much can I execute this properly with higher risk, but also like, do I even feel worthy of this money? Like sometimes when easy come, easy go, people don't feel worthy of the capital they earn. It's like, can you wire out $10,000 and feel like it means nothing to you? Or does that $10,000 mean a lot to you? Because in both cases, it's going to be a big difference of how you can actually express like the full potential of that trading account. And so, you know, I think it's like really sad overall to like pressure people or to like shame people into saying like this was the opportunity of a lifetime, because unless you had like, you know, the ability to make tens of millions of dollars, then I honestly wouldn't give a fuck, because it doesn't make a difference for you.
No, that's beautifully said. And just as a follow-up question, you just touched on social media there, and obviously there are massive positives and negatives. I'm just interested, like, how do you police your social media? Perhaps you've got to the point now where shit doesn't matter.
Yeah, it's very boring. It's just only like pure value, no influences. Ever since TweetDeck kind of didn't work well anymore, I just stopped getting alerts and stuff like that, which I thought was adding value to my trading. I thought like seeing how people think, even if it was specific people who I think are very good, even seeing that, after I stopped like getting alerts and things like that, and I started living just kind of like in a complete isolation in terms of trading, I recognize like it's very noisy, and it has led to me taking certain losses at times. So I like, you know, for example, like Judah would be nice, right? Because he's like actually giving you like news and stuff like that, right? So it's actionable, something that you can interpret on your own. But when it comes down to like opinions, and it comes down to the way that people like want to present like a massive amount of confidence, or even just when it comes down to like pure human like reaction in terms of like, oh, that's a big P&L, but you don't understand like how much of risk was there. Or you might not even, today I even posted about how the fact that like right now this is a great trading environment and good results are expected in a great trading environment. And so sometimes people can have good results that are very appealing. Like just say, for example, like, let's say, for example, a trader makes like 10K and he posts, oh, everyone, I made 10K today, right? No one's going to be like, oh, that's terrible. They would be like, that's awesome, great for you. But what if the opportunity presented for like 100K on a day? You know, it's like you have no idea how people are risking on their account, how much you know, potential was there. And so ultimately, like the use of social media for me is really just connecting with other people that I find like interesting. And if it happens to you know, if you happen to be like a beginner, I would say like put yourself out there in terms of your strengths, put yourself out there in terms of like documenting your journey or cataloging certain things. But like to make it, let's say, a daily practice to look for validation on the internet, or to constantly compare yourself to others, like at some point that has a totally diminishing the negative effect. Ultimately, it's here to like connect traders to improve your abilities. And like, you know, you have to ultimately create friendships with people if you want to get to the next level, because like leveraging friendships, you know, it's, even though it sounds very like networky, it's kind of like if you genuinely like and trust somebody, and you can communicate with them in like an open, honest way, like reviewing your trades or like reviewing your ups and downs, and like understanding like what resources they have. Like, hey, I have a friend that can do this, or I understand certain information better than you do, or I can code, or I can whatever. Like bringing that all together is going to give you such a big boost in your trading and just be more fun. So, you know, hey, 99% of people are not necessarily going to be adding value for you. So like, there's no reason to entertain that. And it's all like, there's a lot of smoke and mirrors as well. So I think like, you know, you have to take it for a grain of salt. You have to get, you know, you have to get misled here and there to really build the necessary skepticism that is required to do this job. Because once you understand like the way that the best traders out there actually operate, it's not like revolving around social media. In fact, like some of the traders I know that are in that like 9-figure level, if you look at their Twitter account, it's a fucking default profile with no posts. And you would never know like who this person is. So you have to be super careful. And you know, it's a great tool just for connection. I think that's like the biggest thing.
Yeah, no, I agree. It's a great tool, but I think ultimately it gets to the point where I think you just slowly gravitate and end up becoming a bit more of a lone wolf. Like I think that just happens. And B, I think eventually it just goes down in the DMs. Like you get to know people. Like I've never like when I used to post a chart really occasionally, like a long time ago, and I never really had anything constructive. Like even if whatever the chart, I never really have anything constructive. I just thought there's absolutely no point. I'm literally doing this just for likes. And yeah, I try and get my dopamine hits in other ways now by ice baths and smashing a golf ball 250 yards, which I actually did for the first time today. But anyway, I digress. I'm just too happy with that. Judith, Brian touched on you being the king of news. And just while we're talking about that, do you use like Twitter for anything like positive, like news or anything like
No,
that?
I don't even have it open on my screen. The only thing that comes through Twitter is what IU like feeds through our chat. But other than that, no, I'm not. I don't really look at Twitter.
Yeah, and Chris? No.
I don't post a whole lot on Twitter, but I do use it to because I follow several markets. I try to find good people in each of those markets, and it helps to give me like a snapshot of kind of what's going on. And then if something exceptional is happening in one market, I can move in that direction.
I definitely think it's not so much during the day, but in the evening, it can be really good just for social sentiment in terms of like, are people pissed off? Are people really happy? And like there are periods where, I don't know, like you might have a certain, I don't know, type of setup, like could be longs, and they're doing really well and they're posting record figures. And you just know that actually we're possibly, you know, coming towards an end of a cycle. So I do think it has some value there. Right, let's move on. And just a reminder, everyone, contest. What is your biggest aha moment or breakthrough in your trading? Best answer will win a free month of IU. And just a reminder, you can join Chris, Judah, myself, and lots of other great traders at Investors Underground, investorsunderground.com/trading takes. And I think, well, we'll see. I don't know how we're doing for time. I just love listening to Brian, I must admit. You've touched on liquidity just then. So have you made a shift to perhaps the more liquid names, and how have you avoided? There's been some really thin, shitty price action recently. How do you go about avoiding that, or do you just accept that might be just a system L?
Well, so I think understanding like especially in this market, you have to understand like how to gauge liquidity and understand volume. I think from my experiences in the past where I was like trading very aggressively, I learned a lot about liquidity, which is not something that I knew about before that point. So I think a lot of people might not be able to relate, but there are a couple actual practical advices or things I would say. Basically, like you never want to be over representative of, let's say, like the maximum volume of like the highest volume candles. So for example, like let's say a 1 minute bar is trading at 500,000 shares, and if you're trading anything less than 300,000, 400,000 shares, you're probably going to be good, and for the most part, like a lot of people will be not experiencing any liquidity problems. The issue is when you become like a larger percentage of those volume bars, and in fact, like if you overwhelm it, like if you become more than the volume that is available, you're going to experience the slippage and the liquidity issues, especially both on the entry and on the exit. And so automatically those trades get invalidated for that reason. And let's just give you an example. So like on a smaller scale, if a volume candle has a 50,000 maximum, then I would typically never go over like 70% of that personally. And if my size happened to be bigger than that, even if it's starter position or something like that, then I completely ignore the trade. You have to be really cognizant of this, especially in small caps, because with these like just kind of like this very nano float kind of era going on, where companies are figuring out they can just reverse split under a million shares, which is actually absolutely insane. Then if you're ever in that position, then you're completely screwed if it goes against you. I know this is not necessarily something that you might have to think about in other markets, but in small caps, it's actually extremely important. So there are always going to be opportunities where you can size to your heart's content. There's millions of shares of trading, back and forth. So to me, like the more size you trade, the more you must wait for the liquid opportunities. And that's just the way it goes. So that's the way I approach it. However, like, in 2022, it's kind of so-so market, basically sized down to the point where I'm just kind of waiting for any signs of life. And I would say in the past, year or so, maybe, and more so, especially in the past couple of months, like it's definitely gone a lot better. So that's kind of like where I'm coming alive. And that's the benefit of doing things like wiring out of your account and kind of like making sure that you can kind of handle slower periods of time or winters for your strategy and be able to strike when your opportunities come. So now is the moment kind of feel like there's an opportunity, and I'm just kind of looking for all the setups that my liquidity can handle. As I grow the account more, if I can't handle the liquidity, then I just pass on it. It's no big deal. And that's just the way that I see it. So as long as you understand the principles of volume, and I know like that tip might not be applicable right now, you still want to consider this aspect of trading, because I've seen even a very small traders trading very liquid stocks, not understanding the way that they actually impact the way that the stocks actually move. And once you actually do impact the market, you have to be hyper cognizant of like how you're going to actually move the bid and lift the offer with your actual trading, and how that affects your actual strategy. Because let's say, for example, you have like a 2-to-1 expectation with a 50% win rate. Well, what happens if you get slipped on the way in and you have now 1.7 times instead of 2 times of your win? And what happens if you lose 1.2 times or 1.5 times or even 2 times? Like it completely destroys your strategy. So you have to be completely aware of that. And you have to be aware of the risks of a float as well. So if you don't understand the way that these small caps are structured, volume, even to an extent dilution, which will increase the float, for example, then I don't think you should be messing around with any of those like super liquid stocks. But I just happened to be like very aggressive and learned a lot of little tricks like routing and ways to like execute positions and like hide them with like icebergs and whatnot. So I would say I kind of pushed the limits on that as far as I feel like can be done. But some of those trades I feel like you gotta be careful, and that is like a sub game that goes on in small caps. So you gotta be careful.
Yeah. I have a follow-up question for Brian on that. So like over time, earlier we were discussing kind of tail risk and the risk of ruin, and different ways that people can reduce that. And you're very good at that by wiring out of accounts and having max stops and things like that. Do you envision yourself basically removing small cap short selling from your repertoire, just as that risk of a real outlier move can happen theoretically at that in that space? And if you were to move away from that, what do you think would be like, what would you move towards?
So I thought about this a lot, because there's like that existential kind of feeling about it. But again, like I know like traders succeed at this, and they continue to succeed at this at a high level. And there's like plenty of scale with introducing new ways of trading your strategy. So for example, like if you're like very aggressive with, let's say, pyramiding or like adding into positions, you might want to reduce the amount of times you add and just focus more on like the small like bat wins. So for example, like, if you're a smaller account, you want obviously like hundreds of thousands percentage of gain on your account, because that's just naturally what you need to do. But say, for example, you have a large account, even moving the needle 3, 4, 5% here and there is actually like very large gain. It's a very substantial amount of money. So all you would have to do is essentially like limit the amount of trades that you take, so your frequency goes way down. But again, like there's always opportunities that come around here and there where the liquidity is like, it's totally enough for even very large accounts. I'm not talking like, Kulamagi style, but I'm talking like, 8-figure level, getting towards 9. And those opportunities persist. You can also kind of trade these like to a longer duration. So for example, like swing trading also enables more liquidity in terms of like position sizing. You might not have like you might not be able to, let's say, get like a 26R risk reward, but let's just say, for example, your account's $5 million and you make 4 or 5R on a swing trade. Like that's still like very substantial. The way I view trading is kind of like, at some point, like you make so much money that it would be kind of sad if you're constantly trading, right? Like I think if you just kind of wait for the opportunities that provide liquidity for you, you have it, you take advantage of it, you go about your day for the rest of the year. Like to me, that's what I would consider like a A+ condition, versus like, how sad would it be if you have like a $10 million account and you're like, I must risk $3 million, $4 million on this trade because this is the opportunity that presents itself, when like there's no marginal utility for your life. Like unless you're actually doing something really meaningful and satisfying with that money over some certain threshold of income, like most people's life is not really going to generally improve that much. So you have to really value like your time and the effort, and actually like what exactly you're trading that money for. So that's what I would say on that piece. But if I absolutely did need to move another direction, then I would go more towards like Kulamagi style, or options are also very interesting because of the risk reward potentials. To me, it sounds like pretty awesome. However, like in my opinion, get really good at something, master the hell out of it, make the money while you can. Like you don't have to think about, hey, I need my edge to persist for 30 years. Think about it more like, if I have like a banger like 1 or 2 years or whatever, like potentially I can maybe even retire. Potentially I could use that money to invest, similar to like how you guys had Jack on. He was talking about how he's kind of going part-time on trading. It's like at some point it makes more sense to let the money work for you, right? Like he mentioned how those percentages don't really make sense. Like you're not going to grow that $1 million account like 1,000%. Like it's just not a thing. You'd rather just let that per year grow at a certain steady rate, and then you can go on and live your life and do whatever you want, right? That's kind of the goal for me, not to endlessly search for the next highest liquidity possibility. Like I'm good at this is what I do.
Yeah, excellent.
No, thank you. And obviously you're having a great month. So my next question was, what's working right now? It sounds like the answer is everything.
It's definitely like an easy market, but that doesn't really paint the story of what leads to this easy market. there was a lot of extreme volatility. I mean, like every day you would see stocks up 500,000%. You would see like huge blowing up situations. I've seen a lot of different and heard of like different stories of like people actually taking like massive losses or getting blown up in these cases. And what it honestly speaks to more than anything is really just if you're resilient, you manage the risk and you kind of like bide your time, like the market will show up for you. It's just a matter of like, you know, not trying to overcompensate when there's no overcompensation that needs to be done. A lot of times people actually just, you know, get so focused on building their accounts and everything like that, that they lose sight of this consistency game and the process of just constantly showing up and just compounding your skills in your account. So like, you know, it's not like it was all easy. Like it's just in like during COVID, I traded so much. I traded very high volume, and I understood how to like stretch my capacity as a trader in terms of like, you know, at some point you're like, hey, I can trade 2 stocks perfectly at a time, and then it goes to like 4 stocks and maybe 8 stocks and like 12 stocks. And it's like at this point in time, the opportunities present itself where I could trade a lot of different setups and a lot of different opportunities because they're presenting themselves at a full capacity where each and every execution is actually like dead on. And that puts me in like this flow state where I feel like I'm doing something that's pushing and challenging my capability. But for example, like some traders in this situation, like newer traders, for example, might only be able to say like, hey, there's 5 or 6 opportunities and I'm going to focus on 2 because that's really like mentally, that's all I can handle at this moment. So I think the biggest difference is really the experience factor where I've constantly been stretched and pushed to the point where like I'm completely confident in my execution across like a lot of different opportunities. That's why when, let's say, you know, people have, let's just say like 10 stocks show up, I consider a mistake not to have the 100% hit rate on all of them, like all potential setups, whereas some people don't, right? So I just capture all the opportunity possible. My system allows me to make quick decisions that I trust. My risk management allows me to mitigate all the losses, and my ability to push the fold in terms of like pyramiding and things like that allows me to maximize on the opportunities that do work. So like there's just like a huge combination of factors, but like at the end of the day, I still think extremely defensively. I've wired out pretty much every single day of this week and a little bit of last week. And I don't intend to like assume that this will always continue. Rather, like I'm going to let it build out this, I don't want to say cushion. I hate the word cushion because it assumes like you can actually just lose it. I would say rather like I'm treating trading as a business, allowing that money to go outside the account. Understand like it affects my mental confidence and my strength as a trader because I have the ability to like, you know, handle whatever adversity may come, and it sustains me for a long time. So you have these like short bursts and short periods and different cycles where opportunities come, you take advantage of them, you pocket them, and it allows you to like go through the rest of the year without any stress, and maybe even for more than a year, right? It can go on. You can basically have years worth of living expenses, more than enough to do things you want to do, like traveling and whatnot, and that completely takes the pressure off. And at that point, you're just trading because you want to, and it's enjoyable, and there's no stress. So I think the mistake a lot of traders are going to make, and I'm very good at predicting this because not only because I've experienced it myself, but also because I'm very clued into the emotions of people. Like I talk to a lot of traders. I also have a good sense of like how traders feel in general, just because I pay attention to the mass psychology. And I'll tell you, like, there are a lot of people who are going to take advantage of this time. They are going to increase their risk. They're going to implement optimizations that only make sense for this market regime, and they are going to give it back or more when things get tough, or they're going to start losing their shit when things go wrong. And I'm just going to be chilling. And the fact that I can chill is what's going to allow me to take advantage of the next time that someone messes up and allows me to take this opportunity again. And that's how you detach yourself from the market. And a lot of people don't understand like that's the key to being able to trade at a high level consistently.
Defense wins championships, right? No, very well said, very well said. And I know the next question you have, I don't think you have an opinion on it, so I will go straight to Chris. Obviously, we had NVIDIA earnings last night. Any thoughts moving forward, broader market, etc.?
Yeah, so on Sunday Scan, Nate and I talked about how the upcoming NVIDIA earnings were basically the validation day. So, you know, basically people
the memes on Twitter were hilarious. It was brilliant, like doomsday, or I don't know, some sort of like 2055 world. It was incredible.
Yeah, so it's basically the market had very high expectations of something like NVIDIA. And if you zoom out, I mean, really the AI sector led by NVIDIA, that's been the main driver of the market this year. And so it's a very important thing. It's kind of like the Pareto principle where, you know, 80% of the results come from 20% of the stocks. If you take that factor further, then it's 4% of the stocks are responsible for like 60% of the moves. And if you do that one more time, it's 1% of the stocks are responsible for almost 50% of the moves. And NVIDIA is that Pareto 1% that's responsible for 50%. So they did have good earnings. It is validated. You know, the thesis goes on, and that takes things like SMCI with it. So I think that that part of the market is set to keep rising or possibly consolidate. But I also think there's something to keep in mind with the rest of the market. And this might be a little bit more my niche as opposed to a lot of traders. But if you look at things like bond yields, those are also rising, and inflation has ticked up a little bit again. So the Fed is in a position where they can't really cut rates yet. And so you have a lot of the other stocks in the market are kind of held back by that. So you have a very split market with like a couple of like, you know, champions that are really pulling things forward. But as you see the risk build up on some of the other stocks, if you had a certain headline or if something comes out, you could easily have a market correction. But I don't call for predictions like that. I just make plans. I recognize what could potentially happen, and I try to just prepare for different permutations of that.
Great thoughts. And Judah, I know you talked about recently that a lot of the breakouts were working. Is that still, you know, very much the case?
Yeah, either breakouts or like gap ups on news. Iova was actually one that I took, which was a recent, you know, they had the news and then gapped up, and like things like that are still working. And like every time within the overall market, you think something's going to pull back down. I mean, we hit new highs. So like those breakouts, those gap ups are still working. And that's like more in the larger cap and higher price names. And even for the lower price names, like trends are still holding. Like if you look, for example, at this, let me share the screen. Like for example, RNA, like this thing is it just keeps grinding higher, and like you're trying to anticipate any pullback, and like all you get is just these higher lows and this continued slowed out grind. Iova, we had this nice breakout and continuation, and NVIDIA, even though like we had this decent like almost 50% move, like this 11%, 10% pullback has helped like wanting to take the trade and taking this breakout off their news. Like a lot of people are anticipating a stock split, which could happen. But at the same time, like every time you think, you know, it may fail and may come back, we just keep on gapping up. So, I mean, like Chris said, I mean, I'm taking it day by day. I'm not anticipating or trying to predict anything. It's more of just, you know, trading my rules and having my risk in place. So I don't have any thoughts on the market. All I know is that we're still in that uptrend and doing a lot of what people aren't expecting it to do.
Yeah, I think that's the key point. I don't know. Yeah, it is certainly that. And just to finish up, so yeah, we asked the IU community and we tweeted out. So we got a few questions for you, Brian. So just a bit of a quick fire. What are some of the things you wish you knew when you started trading, and how would you manage your time relative to the information out there? And that's from Nick on Twitter.
I think The first thing is that I didn't learn too much from paper trading. It's a really good foundation, but you do have to get your skin in the game, in my opinion. The visceral reaction of the emotions is quite powerful, and the best way to experience that is to understand that the market tuition is whatever you want to pay for it. If you want to put in a share to learn the experience, or if you want to put in 10,000 shares, it's up to you. You can really learn quite a bit just by risking very small. And once you kind of build into like your consistency, and you can actually like understand really, hey, I know what I'm looking at now, and I'm doing pretty well at it. So let me just put, you know, like a moderate amount of risk on that. That's where you like really learn quite a bit. I think it's a lot of it comes from experience. So I think I would have just been risking like quite small at the very beginning, and then eventually transition that into 1 or 2% of the account. Nothing too big. Probably 1% actually. I wouldn't recommend a beginner to go 2%. I think that's actually pretty bad. And then really learn the fundamentals of like what consistency can build out for you. Learn a niche. Don't ping pong everywhere. I've seen a lot of traders who were on their way and they got kind of distracted by other strategies, other trading styles, and ended up being mediocre at all of them rather than very good at one. So that's right important. I mean, there's so many things really. It's a trial by fire. Seriously, it's a trial by fire. You have to put yourself in a position where you're not afraid. And that a lot of times comes down to just straight up position sizing. So once you learn all the lessons you need to learn, I would say set some expectations around how much time it takes to become a trader. You know, it's not going to happen for you in 1 year. It might not even happen for you in 2 years. This is a game that you want to really put in like full-time effort, 2-3 years at least. And your expectations should be around that mark. Unless, for example, you had like very good mentorship of some sort.
And next, from Godfather. I think we've touched on this a little bit tonight, but I think it's a really good question. As a systematic trader, what are the best ways to adapt to market cycles and conditions whilst still keeping the core system in place? What can change and what can stay the same? It's funny because I think this is just one of those points that people are really interested in your opinion on.
Yeah, so I think some people, I don't know if this will be surprising or not, but there are times where there's nothing you can do. Like if you're going to max out, you're going to max out. That precaution is there to catch you from doing further damage in outlier situations. And outlier situations by nature shouldn't happen very often. Of course, they can happen a couple times in a row. That's perfectly fine. You need to account for that. But like in those situations, I just take it on the chin and I wait, because you know, you have to know like there's an equilibrium to the market. It sucks that it doesn't get talked about very often, or that like people don't understand it until they go through it. So what I would say is like try to pay attention to cycles, even if you have a very very low level understanding of it, because the more you pay attention to how the markets fluctuate between the psychology of the participants, the more you can kind of mark out like, hey, in January, the market was this way. February, the market was this way. And now I have, let's say, a good amount of information to like go back and look at, like, if I traded my process right now on those stocks of the past, like how would it perform? Recognize if you, again, overcompensated in any way. Try to level it out so that, you know, on average, you're going to capture most of the trades and not draw down like extremely significantly because you're too aggressive, for example. And also recognize like there are going to be outliers both ways. So you're going to have outlier wins, you're going to have outlier losses, and do not overcompensate by changing everything you do to capture those moves. They are things that are going to exist outside your system. You can create a system, let's say, to defend against it or to capture like a bigger move. But like in general, your core base idea should neither be too aggressive nor too defensive. And I know it sounds very broad, but essentially like you have to build enough experience to know like this market's piping hot. I cannot be expecting to trade super aggressively, like adding, and not get punished, or vice versa. This market's too easy. I'm just adding like crazy, never getting punished, and assuming this is always the way it's going to be. It's going to lead to a lot of frustration both ways. You have to look past that and understand the market's going to change based on the way those cycles impact, trader psychology. And in fact, like it's even, I would say, like if you pay attention to what Nate's been saying on the last couple of Sunday scans, I mean, I don't know how many times he said it, but he's been saying so many times, wait for the emotions to flare up, wait for people to get blown out, wait for people to start chasing, right? Wait for the big outlier move, right? He's telling you an aspect of the cycle that affects our market. It's really just about paying attention to that, and then documenting it, and not necessarily adjusting your process too much, but like making sure you didn't adjust too much either way.
Yeah, it certainly seems like it's certainly one of Nate's strengths, and it certainly seems to be one of yours as well. Next question. As a former professional gamer, how are gaming and trading similar, and how are they different? That's from Reza and RU.
It's pretty much if you want to succeed at these things or anything really, it is that self-accountability that we talked about at the very beginning is super important. Like you have to be able to distinguish like what was in your control, what was out of your control, take full accountability for what was in your control, and like work on that. Like the process of becoming a professional gamer is literally just going into the game, assuming that like you're responsible only for your role in that game, or that like whatever you do for that team, right? And if you do it to your best of your ability and everything falls flat, like you don't judge yourself based on the outcome, you judge yourself based on how well you did what you need to do. Like what is your role in that team? So as a trader, like you don't beat down on yourself for something you can't control. At the same time, like you have to differentiate like what is the actual true win, what's actually true loss. There are losses that are very good and positive that you manage the risk properly, and there are wins that are absolutely awful, terrible. You had fat tail risk, you had no idea like what you were doing, and you got rewarded, and like that's gonna mess you up as a trader. So you have to be able to reflect, be very analytical, understand what mistakes you're making, what you're doing well, and just constantly evaluate yourself like in the most like objective way that you can, so that you can just continuously improve and make it perform as best as you can.
And I had a question about, because you were professional at Dota, right? And did you pick Dota because it has I think it's got like the highest prize in cash money? It's something stupid, right? Did you pick it for the cash, or was it a game that you just enjoyed the most?
No, it just happened to become that way. Before it was very minimal price. But like I
wasn't sure if you
when there was no
the dollar signs and you saw like, because I know I think I can't remember, but they have like they got basically like crowdfund for it, right? And it basically had huge amounts.
Yeah, it was like at the peak, I think it was like 40 million or something like that.
Wow,
which is absolutely insane. Like some teams where each player got at least $5 million each for the win. It's life changing. So, but it's very difficult. You still have to be the top 1% of 1% to get to that point.
Yeah, absolutely. I think there are some good parallels between that game and trading in the, your edge is limited by, if you're in a 5-person game, your edge is limited to the role that you can do. You could be winning, I don't know, I've never really played it, but I've played games similar. You could win the top lane and then you're getting smashed in the mid lane, bottom lane. There's no point getting upset. So I think there are some really good parallels between that game. But I was interested in, is there a type of game you think that will lend itself to a certain type of trading? Like if you had I don't know, like StarCraft, for example, would it lend itself particularly to scalping, for example, just if you're used to a lot of actions per minute, or would you just not really buy into any of that?
No, I don't think so. I think trading is a different kind of game. I think if you come in with any sports mentality, whether it's basketball or whatever it is, or if you come in from other games like poker, it's to be good at one thing. There's a lot of underlying principles that apply broadly across the board, and trading is its own thing. but you can take inspiration from a lot of different, sports psychology, or just understand the way that like athletes we all enjoy, like Michael Jordan or Kobe Bryant, things like that. You can take principles from what they do. For example, like, if Kobe's always the first one up, taking a bunch of free throws every single day, working harder than everyone else, you can model your behavior, or you can look at, let's say, someone who's very successful at what you're trying to achieve, so another successful trader, and if you can model their behavior and start thinking like, how would that person react to the situation? How would that person perceive the situation? How would they show up? What are they frustrated? Whatever. Like, try to closely mirror what you're seeing as best as you can, and that's a very good way to be successful by habit. And in the past, it was very, very difficult to understand how people like truly thought, because the internet and like sharing and interviews and stuff like that was not as prolific. So you would sparsely get information about like legendary figures, and still you could piece it together. So I would imagine, like, in this day and age, you just find someone that resonates very well with you and try to assimilate as much of their mentality as possible, and just kind of lean into that so that you can become the person you need to be, rather than like, being lost. Because I think modeling people is like a very intuitive and effective means of improving your potential at anything.
Yeah, thank you. And this is the last question. What keeps you motivated every day to keep grinding after being so successful? And that's from Vivek Trades.
To me, it's all about the performance aspect. And I think what that really means at the end of the day is learning to love the process. That's why Chop Wood, Carry Water is like a highly recommended trading book, even though it has nothing to do with trading. It's learning to fall in love with like the aspects of consistency and improvement. And I feel like, I don't know if it's universal, but I would imagine like a lot of people are motivated by improvement, which is why you can have people who like focus on the reward only, achieve their goals, and then eventually just burn out. Whereas if you get excited about the little breakthroughs that you have and that you constantly seek improvement, it's a very sustainable way to go through life, in my opinion. And I love everything that has to do with like compounding, like anything, because of my experience in terms of like, you can do incredible things by making small improvements daily that seem so insignificant. And then when you look back, you're like, wow, like that, all these things I've been doing have just turned me into a completely different person. And it's the same reason why, like people who work out consistently, like start falling in love once they see the effects on their body, right? Like you start out at the beginning, you're like, oh, it's whatever, I'm just doing it. But then you start seeing how your body is transforming. You're like, wait, this is amazing, because I'm directly influencing, the way that I'm going about in the world. And like, I can see it, I can see the results, I can feel it. That is super motivating. And as long as there's a ceiling that I can reach, and the fact that like trading is such a high skill ceiling, as long as that exists, and I have the passion for it, I will continue doing it. Because I don't know if you guys feel this way too, but at the beginning, I was a year or two ago, I was like thinking about how I can just take more time off, and the idea is really very appealing. But I recognize I actually really like showing up to the market. I really like chatting with my friends, having a good laugh, and like I love teaching people. And I feel like if I had to design like a really great day, like I'm living a great day like all the time. Like I feel like I'm doing all the things that I want to do. And so when there's a lot of things I love doing as well, like traveling, but it gets old. If you go to a new place every single day, like you just miss home, you miss your dog, your cat, your family, you miss your routine, everything. So I don't know. I love doing what I do, and I love the way that I built it. That it satisfies a lot of needs for myself, and I don't feel that incredible pressure because of the way that I went about it. You know, like I can just really imagine if you live and die by the next trade, the next opportunity. You know, back then they said, "Oh, you missed dry shipping, you missed everything, you missed Elfin, you missed everything, you missed Bitcoin, you missed everything, you missed SMCI, you missed everything." No, there's always going to be something new. There's always going to be more opportunities. Don't freak out. Like it's the more you stay in this game, the more rewarding it is, in my opinion.
Incredible. And yeah, I love my routine. And whenever I see one of those tweets like, what does your dream job or what does your dream day look like? I'm like, I mean, it's not too different from what I'm doing on a day-to-day basis. I certainly feel I'm very privileged for that. And that pretty much wraps up tonight. It's midnight my time, so it's probably a good time for us to, just in case I fall asleep on screen. Thank you, Chris. Thank you, Judah. And a massive special thanks to you, Brian. Best place for people to find you, what, Twitter? When you're
Twitter at Brian Lee Trades, you'll find everything there.
Cool, brilliant.
Thank you.
And yes, thank you all.
Thank you.
Amazing conversation.
Thank you, Brian.
Thank you, Brian. It was a pleasure.
Chris, Tim, thank you.
Just a reminder, competition, aha moment, like, subscribe, and we will see you all next week. Thank you, guys.